You open your financial plan and look at the graph. Your portfolio starts here, climbs gradually upward, and eventually reaches the number you're hoping to have when you retire. It's reassuring. The line moves steadily in the right direction year after year. Then reality happens. The market falls 20%. Your account drops $100,000. The headlines are talking about recessions and layoffs, and suddenly that beautiful blue line on your financial plan feels like it was drawn by somebody who's never actually invested a dollar in their life. So what exactly is going on? Why does our financial plan assume something like a 9% annual investment return when we know perfectly well that the market isn't going to give you 9% this year, 9% next year, and 9% the year after that? The answer is that your financial plan isn't trying to tell you what will happen next year. It's trying to answer a much bigger question. Is the plan likely to work over the next several decades? And that's an important distinction because investing successfully doesn't require your portfolio to behave like the line on your financial plan. In fact, it almost certainly won't. There will be years when you look brilliant. There will be years when you wonder whether you've lost your mind. And there will be plenty of years somewhere in between. Today, we're talking about the difference between the smooth, predictable world of financial projection and the messy reality of investing, and why understanding that difference might be one of the most important things you can do to keep yourself from making a terrible decision at exactly the wrong time. Welcome to Plan to Prosper, where we exist to honor God by helping faithful servants steward their finances wisely and build wealth that endures for generations. All right, Logan, I'm excited for today's episode.
Yeah.
Talking about financial planning, something that we do every day, but how that compares with the reality of investing.
Yeah, and how you can take a look at something that looks like a triangle, kind of up and to the right, but also realize that's not what's going to happen.
Yeah. And why we do that, obviously we do it for a reason. We're not just showing you arbitrary numbers when we do financial planning for our clients or prospects. We're not just showing it arbitrarily just for the sake of, we got to put something in there. There is a reason for it, and we try to be as accurate as we can. And I think over time, our financial plans demonstrate a level of accuracy that is pretty proven, if erring on the side of being a little bit more conservative than what reality is. But there's a reason we do it, and that's what we're going to get into today. Why your financial plan is lying to you by not telling you exactly what will happen. We can't predict the future, but why it's not the worst thing in the world, why it's actually really helpful, and why it's helpful to understand what's actually going to happen so that you don't make a bad decision.
Yeah, it is interesting. It's funny sometimes to go back and look at a financial plan that we did 10 years ago with a client that is still a client. We've gotten pretty close on a lot of them. So even though in that 10-year time frame, maybe 5 years ago, it didn't look that close, as it averages out, it actually looks pretty close.
Yeah. So when we do a financial plan for a client, or if you're coming to us and you want to work with us, we'll put together a financial plan for you as well. Even before you become a client, we have some assumptions that we run our financial plans through. The first is an inflation assumption, because we all know what inflation is. We all know that that's the reality that we live in. That stuff doesn't just stay the same forever.
It's become more and more apparent.
Yeah. So we have an inflation assumption. Currently, we use 2.5%. As an average. Obviously, it's been a little higher in some of the recent years, but on average, we're expecting it to level out to be around 2.5%.
Yeah, we're taking a look at averages, what we think the average will likely be over the next 30 years. So while it's not that today, we think that it's likely it could average out somewhere around there.
Yeah. We then make an investment assumption as well. Now, this is going to be different for everybody, but we will work with the client or the prospect to determine their risk tolerance, goals, objectives, things like that, to determine the best portfolio allocation, the most appropriate one for them. And then we'll put together that model in our software, which will give us an investment assumption, average return, annual return to be expected from that portfolio. So in a growth-oriented portfolio, that assumption lands somewhere around 9%, 8.99% annually.
Right.
And we then make income spending assumptions. Now, these are, very specific to the client or the prospect. They tell us what they do for work, how much they make, how much they spend, and we put that stuff together. But even there, it's all projections, because I doubt anybody, save for the most ADD person, or maybe not ADD, OCD, that's the word, has every single penny accounted for an entire year, every year for the rest of their lives. We can't do that. So we have to use some level of assumption here.
Yeah, most of the time, I think, probably. Would you agree most of the time people don't come in knowing exactly what they spend?
Yes.
So yeah, on rare occasion, people will come in with a spreadsheet. I think you're one of those people that keeps a spreadsheet of your expenses and everything. And they know exactly what they spend, but sometimes it's easier to back into it based on what they feel like or know they can save per month or per year.
Yeah. That is without a doubt the easiest way to back into it. Just go, how much do you save at each month? How much do you have, or how much do you have left over on a typical month? And then we can figure it all out from there, because it's a little confusing when you add some liabilities in there. Those end up as a different line item on the assumptions. So it all just kind of works out it's easier to just know what's left over at the end of the month, or what are you actively saving each month. We make Social Security assumptions as well. All of our plans err on the side of being more conservative as opposed to being too aggressive. And so like one of the Social Security assumptions that we have, that because of the Social Security system being a little precarious right now, that
2032 is the year?
Something like that. That's supposed to run out. Social Security is supposed to grow at the rate of inflation. If you recall, our rate of inflation was 2.5%. We assume Social Security grows at 1%, so at less than half of what we're saying inflation is. So that's hopefully conservative, and hopefully they figure out something.
And for clients that come in that are around our age, a lot of times we're assuming no Social Security just to be conservative. We're trying to build a plan where you don't have to depend on Social Security because we don't know what's going to happen. That's
right. Yeah. In an ideal world, you're building an entirely self-sufficient or financially independent portfolio where you reach financial independence without any need for Social Security. If it's there, then it's bonus. It's just extra money you have to invest or to use however you see fit. When we put all that stuff in the plan, you throw it in there, and then everything runs on linear projections. So inflation is 2.5% every single year for the rest of your life. Your investment grows at 8.99% every year for the rest of your life. Your expenses grow at that rate of inflation every year for the rest of your life, etc. That is not what's actually going to happen.
But on a graph, hopefully it looks like just a kind of a gradual stairway.
Right. Yeah. Because when you average it out over time, by and large, this is proven to be the case, that we have to use it, like averages are part of everyday life. And we'll get to some examples that will help make sense. But essentially these financial projections that we'll show you in a financial plan, we are not saying, nowhere do we say that this is what's actually going to happen this year, next year, the following year after that. We are using averages to get to a place where the plan over decades still works.
Because there can be so many things that make that not happen.
Yeah.
It doesn't even necessarily have to be investing. It can be that, oh, you know what? I need a new roof this year, so I got to take $30,000 out of my portfolio to pay for a new roof. So yeah, it can be either due to something that happens in the client's life, or it can be because the markets turn against them for a couple of years.
Yeah. The biggest question that we're trying to answer with our financial plans is not, this is what you can expect to happen every single year, but rather, if your portfolio earns approximately, on average, this return year after year, does the plan work? Oftentimes the answer is no, and we have to figure out how, maybe not oftentimes, but there are times when it doesn't work, and we have to figure that out. Because you might hear this and go, well, then what, doesn't every plan just work then if everything just goes up all the time? Well, no, because you spend money, and we put that take that into account. How much are you saving? You might not be saving enough to build a portfolio that can sustain you for the rest of your life. We want to know that so that we can start to fix it and get to a place where now it works and you're ready to rock and roll.
Yeah, so sometimes that stairway goes up for 10 years and maybe the client comes in and says, hey, I'm 45 and I want to retire at 55. And then we show a gradual stairway down from 55 on. We have to solve for that. So it might be you need to save more or work to 57 or something like that.
Yeah, the point is we're using an inherently unpredictable reality and trying to put in a predictable model that will help come close to what the average reality will be. Right. And the purpose of it is long-term projections. It's not next year's projections. We showed next year, but it's the point of it is, how does this work after year after year after year for a long time?
Yep.
So some analogies that will make sense to a lot of us. I think the easiest one is kind of sports statistics.
Yeah.
If you watch baseball, A good hitter hits 300 or 3 out of 10 times, which is kind of funny because that's an alarmingly high failure rate. You fail 7 times out of 10, but that's what a good hitter does. But you don't expect him to literally get up and every 10 bats, there are 3 hits. That's just not what's going to happen. Some nights he's going to go 0 for 4. He might be in a slump and go 0 for 4 like 6 games in a row.
Yeah.
And then he gets on a hot streak and he hits 4 out of 4 sometimes and 3 out of 4. And over time, that averages out to a 300 batting average.
I'm going to let you guess this after I say it, but my favorite player ever had a lifetime batting average of 264.
Okay.
So should be hitting 1 out of every 4, a little bit more than that maybe.
Yep.
Summer of 2009, he went 28 consecutive at-bats without a hit.
That's a slump.
Do you know who the player is?
Jimmy Rollins.
All right. That just means you know me well.
No, I know stats well. I knew that one. No, I knew that you were a Jimmy Rollins guy. My favorite sport is football. And if a running back averages 4.2 yards per carry, he's not going to gain 4.2 yards every single time. In fact, he's never going to gain 4.2 yards per carry or in a single carry because they don't measure statistics in partial yards.
I didn't know that actually.
Oh, really?
Yeah. I didn't know that was
that they don't measure statistics in partial yards?
That like if you rush for 4.5 yards, are they just going to give you 5 or are they going to give you 4?
I think it kind of depends on because the ball's never placed like the ball's at the 45-yard line. You rush a play. There's not a 45.5 yard line. Like it's placed at the yard marker.
No, it's placed like in between if you land.
Sometimes, but they would never like write that down statistically.
Okay.
They would mark it as one of the
and then just round
1 or 2. I guess. I don't
okay.
I don't know how the statisticians do it. But anyway, so the running back's going to run for 10 yards. He's going to run for -2 yards. He's going to run for 0 yards. He's going to run for 20 yards. He's going to be a Saquon Barkley home run 70-yard touchdown. And over time, it's going to average out to 4.2 yards per carry. Same thing is happening here in our financial projections, right?
Yeah, you're either not either. If we're assuming just about a 9% return for a portfolio, in a typical year, you're probably not going to make 9% on the dot.
Right.
You might make 20%. You might make -10%. You might make 5%. But the point is over if we're projecting for 30, 40 years, we just want to come up with what we think the average is going to be that you will make.
Yep. So, as you said, like what is this 9? Let's just use that 9%, kind of an even round number. What does a 9% return actually look like? Let's start with $100,000 invested. If it earns 9% every single year, like the linear projections show, year 1 you'll have $109,000. Makes sense? 9% of 100 is 9,000.
Yep. And
then the following year, you get some compound interest, so it doesn't go to $118,000; it goes to $118,810. You get 9% on top of the 9% you had the year before, and that happens every year. Then it goes up to $129,500, and that just keeps going. It's beautiful. It just goes nice and straight up and to the right, as you like to say. But that's
as long as you're not spending too much.
True, but that's not what really is going to happen. So instead, it's going to go up 20%, and then it's going to go down 8%. Then it's going to go up 14%, and so on and so forth. But over the long haul, it's going to round out to average around that 9%.
Right. And so that's the best we can use.
Yeah. And I just think it's important to understand that the average is not what you're going to actually experience, because you'll be set up for just massive disappointment and panic when the market is that negative 8%, right, that negative 15% or whatever it's going to be. Those down years are going to hurt when you don't understand the bigger picture.
And as much as people like to, it seems like people like to think that we know exactly what's going to happen in the next year, because we're in the financial industry. It's just not possible to know whether or not next year is going to be a +20 or a -10.
Right.
No, in 2020, in March of 2020, nobody thought that the market was going to end the year positive.
Yeah, exactly. Or March of this year, or March of last year, for that matter. In 2008, the great financial crisis, the S&P 500 fell about 37% in 1 year.
This was atrocious.
In the following year, it rose 26%. The following year, it rose 15%. Following year, 2%, then 16%, then 32%. Like this negative year in 2008 was followed by some extremely strong years, some, normal years, but the 10-year average after 2008 was a 10.39% return with a bunch of random different numbers in between. It all averaged out to about 10%, even with a 37% downturn at the beginning.
That's pretty incredible. That was minus 37% and then 9 straight years of positive. I mean, some of them there was a 2 and a 1 in there, but yeah, positive returns.
And some big ones like 26, 32, 21.
Yeah.
On that note, I have a little quiz for you.
Ooh.
Guess that year. And we're going to use S&P 500 returns for the year, for the calendar year. What was the return for the S&P 500 on the, or I'm sorry, I'm going to give you the return and you have to tell me what year you think that happened in.
All right.
And so these are all the outlier years. I'm not going to give you like a 1.4%, that would be hard. So there's the 5 biggest outlier years, and I want you to see if you can figure out when they were.
Okay.
So the first one was the S&P 500 rose 46.59%.
99.
No. That was 1933.
Oh.
That was the year the gold standard was abandoned. The year FDR was sworn into office. It was probably the lowest point, but before that year happened of the Great Depression.
Yeah. Man, I was way off.
Yeah. So it's just interesting when you think about, the 30s, right? Early 30s, that's smack dab in the Great Depression. And yet there was a year where the S&P rose 46%.
Huh, yeah, because it was, you don't typically think, oh, it was doing great until World War II.
Right. All right, the next one, it rose 45.02%.
86.
This was in 1954.
Man.
So we're now pretty much officially out of the Great Depression at this point. This is kind of the final. I think this is what actually took it back to pre-depression levels.
Okay.
Was this big boom in 1954. It was kind of the post-war boom. Car manufacturing was really taking off. TV, like RCA Holdings, was a big because of TV manufacturing was really taking off in homes. So that was a big year in 1954. Next one, down 47.07%.
87?
That was 1931. So that was the floor of the Great Depression.
All right. I was thinking like Black Monday. I think that was 87.
Yeah. Okay. The next one is it was up 41.37% this year.
Up 40. I'm just going to go back to my original, 99.
Nope. That was 1935. Man. So again, another Great Depression era where in 1933, up 46%, 1935, 2 years later, is up 41%. So climbing out of that Great Depression.
What 34 was.
Yeah, I don't know. It's not on this list, but the New Deal came out that year. The Social Security Act came out that year. So the government was really trying to turn the tide of the Great Depression. And the economy was starting to boom.
It's been a long run for Social Security.
Yeah. And finally, the market was down 38.59%.
38, so it wasn't 08, it wasn't 20. 77.
No, 37. This one's kind of funny because 33 and 35 happened, those 2 big years out of the Great Depression. Then 37 happens and it goes back down 38%.
Man.
I think people thought that the Great Depression was over, and so government kind of pulled back on spending and the economy suffered as a result. And it's kind of funny to me looking back.
Well, I'm a terrible guesser.
That's all right. Yeah. I put together this chart. I don't know if you saw that update, but I put together kind of a comparison of the linear return versus the average returns.
Yeah, I saw it. It's not in my
we'll put it up on the screen for anybody that's watching on YouTube. If you're just listening, pay attention.
Tough luck.
Yeah. I mean, it's really just kind of a demonstration of what we're talking about visually. So there's a 1 on the top where this is just 8.99%. This is a $100,000 portfolio starting in 2026. Nothing else is happening to it. It's just a portfolio that grows at 8.99% for the rest of its life.
You're on the stairway to heaven.
That's right. And it just What's interesting, because of like compound interest, the curve isn't just this straight line up. It's
Right.
this nice little curve because compound interest really starts to accelerate it towards the end. So it starts off and it looks fairly linear, but it's actually it's gonna reach some crazy numbers by the end.
Looks like a hiking nightmare.
So then I ran it through. We have in our software a simulator that runs projections through 1,000 randomly generated market conditions. And so I took the median trial, that 50 percentile right in the middle, that one single scenario that it ran, that trial run, and wanted to see what that did. And so the returns are much bumpier, but nevertheless, it still grows quite nicely. And in fact, it beats the average returns when it comes to the final result. You'll see on the chart that the portfolio by the very end of it reaches about 15 million on the dot, whereas the linear returns only get to about, looks like maybe 11 million or so.
Looks like a bad haircut though.
It does look like a bad haircut. Yeah, it's not as attractive as the nice smooth line. This one looks like a quarter pipe where you can skateboard on it and do a nice flip trick at the end of it. This one
Are
you
you a
wouldn't.
skateboarder?
I used to, back in the day.
Did you do like jumps and flips?
Oh yeah, I was all right.
I could stay on, but I
Okay,
think I got the ollie down, but that was it.
that's good. Ollie's a tough trick. I mean, it's like it's
Most
the one you
basic.
need to learn how. Yeah, but it's hard. Like it's not an easy thing to learn. So yeah, you couldn't skateboard on this one. It's very bumpy.
Yeah.
So just a visual demonstration of what we're talking about. A bad year doesn't necessarily mean the plan's broken. It just means the good years, we can't guarantee that they're going to happen, but to this point, they always do.
Yeah. Hopefully they keep coming.
Yeah, that's right. Okay. When it comes to investing, we would say volatility is the price of admission. You have to be able to stomach it.
Yeah. I mean, either you accept no volatility and you get, in these days, between 3 and 4%, or you have to start including volatility into the portfolio, introducing volatility into the portfolio to get up to 6, 7, 8, 9% returns. And the more you want, the more you're going to be able to, or the more you're going to have to stomach volatility wise.
Exactly. We did a whole episode on risk and the different risks that you assume when it comes to your finances. And you might think that throwing it in a high yield savings account is what's the opposite of riskiest? Least riskiest.
risky.
Yeah. I don't know. Is there a word? Safest?
Yeah.
The safest thing you can do with your money.
Risk freest.
Risk-freest. But in fact, you're subjecting yourself quite a lot to inflation. Obviously, the goal of a high-yield savings account is to keep up with it, but they're allowed to change those rates anytime they want, and they do, and they have been. And so that rate could start to go down, and it's suddenly not looking quite as good with what the inflation might be doing, even if that is the goal of it. And so you can't want the 9% returns, but I'd rather not experience the negative 20% returns. You can't really have both.
Yeah, there was it Markowitz? I can't remember. I think it was Markowitz. Came up with the efficient frontier.
Yeah.
Where it's just kind of that XY graph, and on the Y-axis it's return, and on the X-axis it's risk, and so it just kind of does this. The more return you want, the more risk you have to take on that X-axis. I think I got those right.
I think so
always get
too.
X and Y confused.
Yeah.
And kind of the goal is get as close to that efficient frontier line as possible.
Yeah. This is a reality that exists across our lives as well. So like you can't say, I want to get married, but I never want to have an argument with my spouse. I want to have kids, but I always want them to obey me and never disobey me. That's not going to happen. You have to be willing to accept the reality of a messy life in a fallen world.
Yep.
And it's not always going to be so clean and never encounter issues.
Yep, that is true.
I think the fallen world functions the way that it does, and obviously, like sin is not when it comes to the sinful part of the fallen world. God doesn't look favorably upon sin, and yet He actually does use it to still accomplish His purposes. Like if you look at Joseph's brothers, what they did to him. or even just the reality of like the curse. Like it's not necessarily sin. Sin is what brought the curse in, but like just the difficulty of work. That's not a sin. It's a result of sin, but it's not like that this is sin because work is hard. So God uses these hard experiences to help us grow. And I think even in investing, it might sound silly to say that like God will use a a year of down and the markets are down. But I think God can use that to sort of test our faith and make sure that we're not trusting in these riches and trusting in him instead.
Yep.
So the down years kind of additionally financially, they present some unique opportunities as well. So I think it's tempting to look at down years as like, it's all bad. But there's actually some unique opportunities that can come as a result of that. Things like tax loss harvesting. Mm-hmm. You were talking about that yesterday with somebody. Like, explain how a down year, there's actually some unique opportunity to help a client's portfolio.
Yeah. So like one of the perfect examples was the tariff tantrum when the market was down, I don't know, it was probably down 15 to 20% in the span of a week in March of last year. And so what we did was anybody who had recently purchased S&P 500 type exposure through a mutual fund or an ETF, we shifted out of the one that they got into because it was trading at a loss, and we shifted into a new one that's providing very similar exposure, but that allows you to harvest the losses in the one, end up with the same exposure due to what you just purchased, but then it can grow from there, and you've realized losses and have unrealized gains as it goes up.
Yep. Another opportunity in down years is just continuing to be able to buy at lower prices.
Yep.
So you get to sort of get a discount on some of these funds that otherwise were a little bit more inflated, and in the really good years get more expensive to buy. So another opportunity there.
But the media doesn't like to let you think about those. Because I can remember 2008, 2020 getting on CNBC, and all you see is like the traders on the trading floor doing something like that.
So the next time the market drops, the worst thing you can do is sell. Don't do that.
Right.
The best thing you can do is buy. Get in there, baby. Get some more money in the market.
Oh, yeah. Buy those cheaper stocks.
Exactly.
It does depend on your financial situation.
Yeah.
Don't just blindly buy.
Of course. We would never say that. You and I were supposed to go golfing today.
Yeah.
It's not going to happen because it's
like isolated tornado watches and stuff. Yeah.
See, I was down for it.
I was down for it.
Have you ever seen Caddyshack?
I don't think I've ever seen it the whole way through. I've seen bits and pieces, but I need to see it the whole way through.
You got to watch like the TV edited version of it. But there's a scene where this guy is golfing, and it turns into like a monsoon thunderstorm, and he's just having the round of his life. And so he keeps going because he's like, I'm playing the best I've ever played, even in this thunderstorm. So he keeps going. I think, if I recall, I think he finishes the round, and he like set his own personal record, and then he gets struck by lightning. I think it's something like that. It's very funny. So anyway, we're supposed to go golfing today, and you go, I want to shoot an 85 today. Therefore, 85 divided by 18 holes, that's 4.7 on every single hole. You can't do that.
4.7.
Yeah, it's not going to happen. It's like the running back average. You're going to shoot a 6 on one hole, a 4, a 3, a 5, and eventually you're going to get to that 85 score.
85, I'd be happy with 100.
Yeah, I've never shot an. Actually, I think 85 is the best round I've ever had. It was one time only. It's probably never going to happen again.
I think my best round was a 96.
Hey, that's pretty good.
It's been a couple of years. And I actually think it was in like a monsoon.
That's sweet.
I was supposed to play with a few friends at like a scramble outing.
Yeah.
And same thing. They were calling for thunderstorms and everything. But one of the guys and I looked at the weather and we're like, I think we could squeeze a round in. And so we got through like 7 or 8 holes, and it just started pouring. Mm-hmm. The guy with me stayed in the cart the whole time and just watched and he kept saying like, Logan, if you don't hit the fairway this shot, we're leaving. And I would hit the fairway. And he was like, I've seen you play so many times. I expected to leave like 4 holes ago.
That's incredible. Yeah, there's something about playing. You're like playing with house money in that situation where it's just like nobody's out here. I can just swing away, and wow, it's actually working. And there's probably a lesson there too. We should play more loosely when it's perfect conditions
Just
too.
calm down.
All right. The goal isn't to predict the path; it's to build a plan that can survive it. Because we don't know the future. We don't know which years are going to be the good years or the bad years. We have to just get in and stay
plan
the
for
course.
what we know.
Yep. The reality is like we have to use assumptions in financial planning. We can't predict the future, so we have to put something in there, and we're using historical averages as well as like some predictive things to, again, not predict the future, but try to figure out what direction we're going. And the point of it is to try to build something that can sustain long term.
Right. And so as you're looking at your financial plan, don't look at it and think, oh, my advisor said 8% every year. And then you look at your statement, you're like, I'm down 12%. Well, you said 8%, so you're just wrong. Well, we're doing the best we can with the averages.
Exactly. One of I already referenced this earlier. We run this simulation that does account for the volatility of the markets, and it's called a Monte Carlo analysis. It's not the end all be all, but it is a very helpful way to account for the reality of the markets. And so, like I said, there's 1,000 randomly generated scenarios of potential market returns 1,000 times. And given there's bad years in there, there's good years and everything in between. And of those 1,000 scenarios, how many times out of 1,000 did your financial plan succeed? That is, you reached the end of your life, the end of our projections, and you still had money left over. And we give them that number, and we see somewhere in the 80s to 90s is a pretty healthy result that we're comfortable with, no matter where you are. Even if you're close to retirement, we think in 86 or so or higher, you're locked and loaded and ready to retire if you've got a plan that's in that range.
Right. And a lot of times we like to challenge people at 100 with, what else might you want to do with this money?
Yeah, we'll stress it and just go 100% it's actually not ideal. Like let's see, you have more room to give some money.
Yeah.
You have more room to spend money if you want.
Yeah. Start giving your inheritance away little by little, or what you want to leave to your inheritors little by little. Watch them appreciate it now. Yeah. Anything like that.
Yep. And a Monte Carlo analysis, again, is not predicting the future either. It's just kind of stress testing the plan.
Yeah. Yeah. I mean, there's a mix of using the Monte Carlo to stress test it, but then also we can kind of pull levers to stress it as well. Like, I think there was one client where he had gotten up to like, you could spend $80,000 more a year.
Yeah, exactly. So I think when we'll kind of wrap things up, you should expect the financial plan to be a little boring. It's just, this is what happens year after year. Yeah, there can be some scary plans too. But
hopefully it's not one of those exciting ones like, oh, right now you're barely going to make it.
Right. But if you're building a healthy plan, it's going to be boring year after year, same thing. But expect reality to be a little bit more exciting. You're going to have some good years that are go way beyond our 9% projection. You're going to have those plus 20% years. And we've had a few of those years recently where the markets have been good. Yeah. So those are fun.
But since 22, markets have been pretty good.
Yeah. But 22 happens.
Right.
And the markets are down. That's,
And everybody on the trading floor is doing that.
Exactly. Whereas we're at Stonecrop, we're like, huh? You want to buy some more? Put some more money in the market, What do you think?
Call Dalton, that's all he talks about. You want to buy? You want to buy?
Yeah.
You want to buy?
Hey, I'm an opportunist. So life is exciting. Life wouldn't be good if everything was just the same. It was slow. Like, I think it's fun to have a little bit of variety mixed into your life.
Although you're very, you need to have I'm blanking on the word, do the same thing every day.
Yeah.
What's the word for that?
Consistency. I don't know. Routine, rhythms.
Routine. That's the word I was looking for.
I am a big fan of that. Like, I'm a big fan of being a consistent person, showing up each day, progressing a little bit each day. But even in that, like, you have good days and you have bad days, and you can't really grow unless you experience the bad ones too. Like, so I'll go back to like the marriage thing, like the argument thing. I don't think you have a healthy marriage if you never argue.
Right.
Because you're two people with different lives and different brains and different spirits, and there's different sin habits and things. And I think arguments in your marriage can actually and should make you stronger as a marriage. It can obviously go the other way. If you argue all the time, you never agree about anything, and you just resent each other for that. But a healthy marriage will have the arguments and grow and figure out a way to move forward in love.
Yeah, true. Can't disagree.
Sweet.
But on routines, I mean, I'm the kind of guy that yesterday I was in the office at like 7:15, and then today I decided to do a little bit of work at home, and I was a little bit late for this podcast.
You were. We were just sitting around waiting for you.
That's what it looked like you were doing when I walked in.
But we made it. Do we have any other things to say about these projections, these ideas?
Let's see. You already talked about that. I don't think so.
Yeah.
I think the big takeaway is that markets are going to move.
Yes.
It's not going to look, reality isn't going to look like the plan.
Yes.
The linear plan.
Right.
But hopefully as it goes, you'll kind of continue in a bumpier manner. You'll continue looking like the linear plan.
That's right. And like you said earlier, if you work with a financial advisor, or if you work with us and you're with us for a good length of time, we can go back to that first plan we ran for you and see what did we project your portfolio to be 10 years from now. And if you've been with us for that whole 10-year period, we can go in that 10-year meeting and go, look back at that first plan and go, hey, this is where you actually are. This is where we said you would be. You're actually ahead, or you're actually kind of spot on. And we'll look at that. And again, like you said, like we're often surprised ourselves. It's like, yeah, we were pretty close on that one.
Yep.
But obviously a lot of your behavior can impact the way you get a huge raise. You spend more money, you spend less money, you save more money. There's lots of levers that you can pull to affect the way that the projections turn out.
You could be way behind because you told us, oh, I spend $150,000 a year, and you actually spend $200,000 a year.
Right. So we need to use accurate projections. We strive to get the best data as possible from you so that we can run accurate projections and hopefully establish this long-term success rate where, yeah, we're pretty close on these plans succeeding.
Yeah.
That's kind of the point of, when you have a financial advisor, you meet with them regularly to update the plan. That's our goal with our clients, is to meet at least annually to run your financial plan update to ensure that you remain on track.
Right.
Because we don't want to just meet in the first year and go, all right, we'll meet again when you get to 65 and you retire, and we'll see how you did. Nope, we're going to check
Good
in.
luck.
We're going to check in next year and see, you still on track? No, we got to make some adjustments here. You're still on track? Yes? Good. Keep going.
Yep.
So, this was a fun episode.
Yeah.
Thanks for tuning in, and tune in again next week.
Don't get blown away by the tornadoes.
Nope. God bless.
God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.